Hey, good morning, everyone. Marty Missouri here, 27th of February, 2022, with a technical update for you that I'm going to try to keep relatively quick. Thursday morning, we took a look at the market. We took a look at agricultural commodities, metals, silver, and gold, and lots to talk about in all of those areas. We had quite the action from the time I shot that video Thursday morning when the S&P was down about 1% to Friday evening, quite the dramatic turnaround. So from a technical perspective, we really want to see how meaningful is that big move we saw the last day and a half of last week. So for this morning, we'll just focus on the S&P and the NASDAQ. I'll take you through the weekly, the daily, and the hourly charts on the S&P, just like I did Thursday. Then we'll look at the NASDAQ daily chart, but then I want to show you the NASDAQ weekly and some work I did yesterday on the weekly moving averages and kind of look at an interesting historical setup with regard to the NASDAQ. And then we'll just leave it there, and then I'll circle back again next week with, maybe more on the other commodities and other things that I think are interesting and worth looking at here, technically speaking. So again, in front of you is the weekly S&P 500 chart. And when we were looking at this on Thursday, this candle right here, that's the weekly candle. It was actually a full-bodied candle, and it was completely red. So from here to there was just this big red candle, looked like a momentum-filled shot lower below that 50-week moving average. Now it came back. Unfortunately, from a technical perspective, it didn't recapture it. Actually found resistance right on that line. So that right there, again, impressive rally. Falling short of recapturing this line that you can see it's been doing battle with for the last several weeks. Not necessarily a good technical sign. And then when you look at the moving average convergence divergence, that's just a widening sell signal there. Nothing really to get excited about there. And the RSI, the relative strength index, continues to drop. On the daily, we got into this oversold range. This is what it looks like on the weekly, and you can see that often precedes a big bounce. Not there yet. So there's still some work to do, and notice the gap still between the price and the 200-week moving average, which has been pretty good support. That's the one I want to show you with regard to the NASDAQ Composite Index. And then the daily chart, when we looked at that on Thursday, we had this candle. There was a big gap. There was a big space between here and here. And we were down here at these levels, coming off of the lower levels. And I made reference to this support line, right, which was support during these periods, pretty good support over the last year or so. And how that could offer up some resistance. And I did suggest that, it'd be very likely that we'll come back and test that. Well, we passed that test with flying colors, right? We closed at the high, just exploded right back through that level. So that, right now, as I speak to you, is, that is a positive, of course. Now, there's a lot of technical damage yet to be repaired, of course. We've got this downtrend line, and we still haven't broken through that. And once we do, we're going to be struggling with a 200-day moving average and then a 50-day moving average, which is sloping in the wrong direction. That's not a good technical sign. So a ton of resistance if this market wants to continue to try to battle its way up. So it definitely has wind in its face, so to speak, to get all the way back up to these all-time highs and beyond. But I did point down here on a near-term basis to some nascent potential positives, and those were in the momentum indicators. And I said that, if this does turn up, this is going to turn up, and we're going to have a higher low on both of these versus a lower low in the price, and that actually is a very bullish setup. So as this began to develop, we saw this begin to turn, and suddenly, yeah, that makes very good sense that you get a big pop here. What would be really ugly, though, is if we lose it below this line and we come down, and then we end up, confirming that with lower lows here. So that remains to be seen. But again, technically, short term, things began to look positive late day Thursday. Longer term, as you can see here, like I said, a lot of technical damage to repair, and the weekly doesn't give us much at all to be optimistic about right here. Then we zoomed in on the 2-hour S&P chart, and I pointed to this falling wedge pattern, which by itself is a bullish pattern, but for me, not until you get positive divergences here. We didn't have those, but I did point out that these oversold levels were pretty compelling, and that it wouldn't surprise me, although this wasn't an ideal setup, but it wouldn't surprise me if we got a good pop right here. And sure enough, we did. We popped out of there really strongly. You could, if this comes back a little bit, on the short-term chart, you could even have a bull flag, which, some technical traders might get excited about. You don't have that pattern yet, but you need to chop in here a little bit. And again, this is really short-term. This would be for the intraday trader, if there's any of you out there watching this. We zeroed even further in and looked at the 1-hour chart. And as you might recall, I pointed to what was a positive divergence down here on the RSI. So that was a little better look than the 2-hour chart. And again, you got that nice big pop out of here, right? And so, that's the pattern we're looking at right now. We ended up with a news conference from the president that talked about sanctions that weren't as draconian, perhaps, as the market was already discounting. And then there was rumor that Putin would be ready to have some talks and maybe negotiate something with the Ukraine after he spoke with Xi from China. Since then, as you may know, and I'm speaking to you on Sunday morning, conditions have deteriorated notably. And I'll come back to you probably midweek with an update of the charts to kind of see how things are playing out. And let me say it for the umpteenth time, folks, whether you're a bull or a bear, this is a time for no breath holding, so to speak, because the market is going to continue to see just monster gyrations. Right now, it's very headline driven. Traders are coming in force and gaming it in both directions. We do have rising short interest in certain important places in the market. Our fear greed barometer is actually green to the tune of 40 points, and it oscillates between up 100, minus 100. And green means that we've got growing pessimism, and it was only a green 10 here, a positive 10 here a week ago. So that means there's been growing fear in the market. So in theory, when there's growing fear, a lot of people have exited. And presumably then there is a lot of people who can re-enter, right, and buy shares back and push those things up higher. And when people are shorts, they're very exposed to an upward spike, and they have to cover those shorts. We talked about that a lot over the years, and I won't belabor that here, but short covering rallies can be violent to the upside. And then there's that whole situation with gamma hedging among options dealers. If the market moves away from them, they have to hedge their exposures, and that can push the market firmly in either direction. And obviously, I think a lot of that has gone on here those last couple of days. And so some of this is just, underlying market dynamics that have to do with protecting, buying out of need to hedge as opposed to optimism. So a little bit of both, no doubt, but what a fluid, volatile situation we have on our hands right here. When we looked at the NASDAQ composite index on Thursday, we had a candle that was just right here, dipping its way back into positive territory. So actually the NASDAQ at that point was moving back into the green. Updating, the pattern here, you do have clearly, from here you have what looks like a falling wedge and so on. And then again, that was Thursday, and then Friday we had that nice big day right here as well. So we definitely have a bullish falling wedge with, right, your nice bullish divergence here on the RSI and on the MACD as well. So again, really began to look positive on a short-term technical basis with regard to the NASDAQ as things developed here on Thursday and Friday. However, when we zoom out and look at this on a weekly basis, for starters, we have just really ominous negative divergences, right? Things really rolling over as the NASDAQ was reaching new all-time highs. And remember that breadth, advanced decline line breadth indicator I was showing you was just really giving us a strong signal that this was about to roll over. And that played out pretty much on cue as we charted for you here. Now, what I did yesterday was really worked on the weekly chart. And what I've noticed is that if you go back all the way, say, to the mid-90s, so we're going back nearly 30 years. You've got these slow moving, long-term averages. So again, this is the weekly chart. So this is the 50-week moving average and the 200-week, nearly 4-year moving average, right? So when we go back, several decades and look at periods when on a weekly basis, the NASDAQ composite crashed through the 50-week moving average, right? There's been lots of tests. It's been really good support. So if you're in a bull market and you think we have bull market conditions, man, when that thing hits the 50-week moving average, buy it with both fists, right? But if it breaks down, and particularly if that 50-week moving average begins to roll over, virtually every time we ended up with a test at least of the 200-week moving average. And when we were in bear market conditions and we crashed through that, it was horrific. It was 80% drawdown on a weekly basis for the NASDAQ when the tech bubble burst, and 56% drawdown when the mortgage bubble burst, right? But beyond that, when we just came through, and these are bear markets. They're just not incredible bear markets. They're textbook bear markets, if you will. But to me, this is the real deal. This is really our definition. It's protracted, does a lot of damage, if you will, or corrects a lot of excesses in the market, maybe to put it that way. But again, so notice though that when we came through it and tested and lost it, virtually every time we ended up testing the 200-week moving average. And you can see when we did that in 1998, we ended up with a 33% decline in the NASDAQ. And again, we touched on these. And then beyond that, here we had the market beginning to recover from a devastating bear market. So here's where the moving averages were really close together. But, as it penetrated both, we came through with 19%, 14%, 15% drawdowns. Disregard the ones in parentheses. That's if you annualize that number. And then here, 19% during the whole European debt mess, right? 20% here. And then as the market began to expand, in 2016, we were starting to get some widening here between these two. We ended up with a 20% decline once we touched that. During the fourth quarter 2018, 24% decline. About 33 during the COVID lockdown situation. And here we are today, folks, and this really is giving us that look. We broke through the 50-week moving average, came back, tested it, failed that test, and are sitting somewhat below that. So history says, right now, if history were to rhyme, we're ultimately going to go down and test this 200-week moving average. And if we do that, that's a not small 32% decline. And if things begin to break and, margin calls come due and stop losses get hit somewhere around there, we could be looking at something more substantial. According to our macro assessment, we don't have recessionary conditions right here, which we did here leading into this, and here, leading into this. So we don't have that today. We did have that here, by the way, leading into this. And then the market got rescued with trillions of stimulus and purchase of junk bonds by the Fed and that sort of thing. But we don't have that. We don't have, by our score, recessionary conditions. So we may just get, if anything, this test of the 200-day moving average. But anytime I mention that, I do have to offer the caveat that were it not for all that printing, we would not be experiencing the somewhat bullish macro conditions that we see right here, although they have, as I've shown you, they're not as bullish as they were, say, a couple months ago. Nevertheless, they're not recessionary, but I think we probably would be still fighting our way out of the worst recession in history were it not for just a utterly unimaginable, by any historical precedent, stimulus effort by global central banks and governments, the US's in particular. So, of course, that brings with it other issues and challenges and inflation and bubbles and things that we have to contend with later. And ultimately, they effectively created a scenario where a recession did not really do anything in terms of the necessary purging of the excesses that built up during the previous longest expansion in history, which I say we're still in, that this really didn't count because of the brief nature of it. So again, something to keep our eye on. Very interesting technical picture that has historic precedence. So that's the setup with equities. Yes, it was a good day and a half last week on the weekly charts. Kind of meaningless. We didn't really recapture Any key technical areas on the daily chart? Certainly reason to be optimistic. However, the news over the weekend is not optimistic, and there's much to talk about there. I'm hesitating because it's so fluid, and these kinds of things can twist and turn at a moment's notice, and it can have short-term meaningful impact, or what appears to be meaningful impacts, I should say, on the market. Over the weekend, what the European Union, the United Kingdom had already proposed this. Looks like the U.S. is on board, and that is removing Russia from the global payment system called SWIFT. But there's also apparently some maneuvering going on so that it doesn't necessarily affect payments around energy sales, which are critical to Europe in particular coming out of Russia. So we'll see how that plays out. What's happened so far is you get these big verbal threats, and then thinking that the world's going to really go all in on punishing Russia with various sanctions, only to find out that these country by country, they've got some personal interests that are keeping them from going there. But the news over the weekend, as we get more feed from what's going on in Ukraine, is that countries are looking to step up and expand those sanctions into more meaningful areas, even to the point where the Russian central bank gets hamstrung in terms of its ability to operate, monetary functions on behalf of Russia. Right now, as I sit here talking at you this morning, we would be looking at some notable downside volatility if the market were opening right here. So, folks, I'll leave it there for now, and look for the morning note tomorrow, and of course, lots coming your way as things play themselves out. Take care. Bye-bye.